Assalamualaikum to Dr. Nuhuda. This is the presentation of Group 5 for Business Analytic and Financial Modeling subject. We will start by introducing our team members. The first one is Hirani Hitus, Atika Ayuni and Marzatul Izzati that will be presenting for Maxis Berhad, while Khairul Nuraini, Muhammad Nurhazi and Muhammad Shahmi will present for the Celcomdigi Berhad.
Assalamualaikum and I'm Hirani. Let's take a moment to imagine Malaysia fully connected, not just through mobile phone but through smart homes, digital business, 5G power innovation. That's the future. It's already unfolding and Maxis Berhad is one key player making it happen. Maxis Berhad, founded in 1993 by Tan Sri T. Ananda Krishnan, is one Malaysian leading digital telecommunication provider. Headquartered in Kuala Lumpur, Maxis offers mobile fiber enterprise solution reaching over 95% of the population. With strong presence nationwide, Maxis also frontrunner in 5G, AI, cloud service, supporting both personal and business digital transformation. The company mission is clear to bring together the best technology to people, business, and the nation, always ahead in changing world. Its vision reflects the commitment to be Malaysia's leading converged solution provider. Maxis' objective is to leading Malaysia digital future with innovation and customer-first solution, guiding the company culture based on 4 core values, which is customer-first, delivering personalized and high-quality service, what possible, encourage innovation, creativity. I am Maxis, promoting ownership and teamwork, and lastly, agility, adapting quickly into changes. Digital leadership play a critical role in Maxis' performance. Let's focus on these two important people. Goh Seow Eun is the CEO since 2022, brings vast experience in telecommunication and has been instrumental in expanding 5G adoption and enterprise solution. Meanwhile, Dato' Johan bin Idris, appointed chairman in 2025, strengthened the board of directors with decades of experience in audit, finance, and governance. This enhancing investor in confidence and corporate accounting.
Now, let's take a look at the liquidity ratio of Maxis Berhad from 2020 to 2024. So, the current and the quick ratio remains consistently below 1.0, indicating that Maxis not have the enough current asset to cover its short-term liability. Although they peaked at 0.63 in 2020 and 2022, but they fell to 0.52 by 2024, showing the weak of the liquidity. And then the cash ratio also declining from 0.16 to 0.08, suggesting that the lower cash received, which make the company more vulnerable to short-term financial pressure. And then additionally, the net working capital to current liability of Maxis was consistently negative, highlight that the working capital deficit and the possible dependence on the short-term finance. And then we can move to the next ratio, which is the financial leverage. The first one is total debt ratio increased from 0.68 to 0.75 before slightly easing to 0.73 in 2024. So it indicates that the heavy reliance on debt financing. And then the equity ratio also dropped from 0.32 to 0.25. That's suggesting that Maxis is very depends on equity over time. And then for the last one is long-term debt ratio that stay between 0.36 and 0.43. That meaning a large portion of its debt is long-term helpful for easing the short-term pressure, but still the Maxis have a long-term commitment. Next, we will move to the asset utilization. The receivable turnover range from 4.18 to 5.09 is indicating that Maxis collected payment about 4 to 5 times a year. However, the trend declined after 2021, pointing to a slower collection. The average collected period stay high, between 71 to 87 days per year, suggesting that delay payment or a looser credit policies. So as a telecom company, Maxis hold a minimal inventory, so the inventory turnover ratio doesn't meaningful in these cases. For the final ratio, which is the profitability ratio, the gross profit margin decreased slightly from 44% to 40% due to the rising cost or the pricing pressure. And then for the net profit margin, it also fell from 15% to 10% in 2023, but it's recovered to 13% in 2024, indicating that improving profit control. For ROA, it's mirroring the pattern, which is declining to 4.35% and then rebounding to 6.2% in 2024. It shows Maxis in the better asset efficiency. And then for the last one, which is ROE, stays strong, rising from 90% to 23%, meaning that Maxis continues to deliver a solid return to a shareholder. And in the summary or the conclusion, while the Maxis face some financial operational pressure in mid-period because of the COVID-19, signs of recovery are clear in 2024, especially in the profitability and the
Forecast
interest
income
cover.
statement. Let's begin with revenue. The company show consistent growth in sales over the 6-year period. Starting from 10.5 million in 2024, revenue increasing each year to reach 12.6 million by 2029. This upward trend suggests the company is expanding its operation and is likely capturing more market share. For example, this could be due to higher demand for its product, expansion into new market, or stronger pricing strategies. Although revenue is increasing, net income is fluctuating. In 2024, the company earned 1.369 million in profit. However, profit fall in the following year and never quite returned to the 2024 level. This indicates that the company might be struggling to manage its costs, which are likely rising faster than revenue. In line with this, the earning per share or EPS also dropped. It goes from 70.80 cents in 2024 to 50 cents by 2029. What this means is that even though the company is selling more, shareholders are getting less value per share, which can impact investor interest and confidence. Next, looking at the balance sheet, total assets remain fairly stable. They moved slightly from 22.3 million ringgit in 2024 to 22.7 million ringgit in 2029. This tells us that the company is not aggressively expanding or downsizing its asset base. For instance, it's not purchasing many new properties, equipment, or investment. This stability can be good if the company is maintaining efficiency, but it also means there may be limited growth in asset investment. Now, this is where we begin to see concern. Total liabilities are increasing every year, while total equity is shrinking. In 2024, liabilities are 60.3 million ringgit, and they rise to 18.4 million ringgit by 2029. At the same time, equity dropped from 5.9 million ringgit to just 4.1 million ringgit. This shows that the company is becoming more dependent on debt rather than funding growth through its own profit or investor capital. For example, it might be borrowing more to pay expenses or cover shortfall in operating cash. Over time, this puts pressure on the company's financial health and limits its ability to borrow in the future. Forecast in cash flow from operation is also declining. In 2024, the company generates over 3 million ringgit from its core business, but by 2029, this dropped to 1.7 million. This decline tells us that even though sales are increasing, that business is struggling to convert that revenue into actual cash. As an example, this could be caused by rising overhead costs, lower collection rates from customers, or inefficiency in operation. If this continues, the company may have trouble paying for its day-to-day activities. Interestingly, we see a shift in investment activities. Starting in 2025, investing cash flow become positive. This suggests that the company is no longer spending heavily on new investment and might instead be selling off assets or cutting back on capital spending. While this can help support cash reserve in the short term, it also means less focus on future growth, which could affect long-term competitiveness. Now, the most serious issue appears in the ending cash balance. In 2024, the company has 453,000 ringgit in cash at year-end, but every year, this balance declines. By 2028 and 2029, the cash position turned negative, ending at 260,080 ringgit. This means the company is expected to run out of cash if no changes are made. Negative cash balance indicates a real liquidity crisis, which may require new borrowing, asset sale, or emergency funding. Summary: while the company's sales are growing, it is facing challenges in maintaining profit, managing debt, and sustaining healthy cash flow. To address this, the company should focus on improving operational efficiency to protect profit margin, controlling borrowing and liabilities to strengthen the balance sheet, rebuilding cash reserve through better working capital management. If these actions are taken early, the company can avoid financial distress and return to a stronger and more stable position.
So now we will continue with the second company, which is Celcomdigi. Celcomdigi Berhad is the largest mobile network provider in Malaysia, resulting from the merger of Celcom Axiata and Digi Telecommunication in December 2022. The company is headquartered in Subang Jaya and serves over 20 million customers with voice, data, digital, broadband, and enterprise solutions. Celcomdigi is listed on Bursa Malaysia under the name Celcomdigi. The company is committed to network excellence, digital transformation, and innovation. It supports the development of Malaysia's digital economy and the inspiration for future 5G
Next,
deployment. We will continue with the mission, vision, and value of Celcomdigi Berhad. So the first one is the mission of Celcomdigi is providing safe, inclusive, and sustainable digital access, supporting the digital business ecosystem, and empowering communities and strengthening corporate governance through a 5-year ESG initiative. And next one is the vision. The vision is about advancing and inspiring society through technology and innovation while also being an inclusive and responsible digital entity. The third one is called Celcomdigi aims to build an inclusive and secure digital society by providing access to technology for all. The ultimate goal is to be a responsible and sustainable digital leader in Malaysia. And the last one is the value is to being customer-centric by providing exceptional service to over 20 million Malaysians. It fosters a high-performance culture driven by efficient processes and teamwork. Celcomdigi believes in being stronger together by leveraging diverse talent and in being responsible and caring with commitment to integrity, inclusivity, and creating positive impact. The last one is the leadership and board of directors. Celcomdigi is led by a wide range of management and board of directors in the telecommunication and digital industry. The first one is the Chief Executive Officer, Dato' Ilham Nawawi, played an important role in uniting Celcom and Digi's operations. He is assisted by Deputy CEO Albert Murty and Chief Financial Officer Dennis Chia, who has more than 30 years of experience in corporate finance. Other senior officials include Chief Technology Officer Kesavan Sivabalan, Chief Strategy Officer Eric Merrill, and Chief Customer Experience Officer Lau Yin Mei. And the next one is the Board of Directors, include Yang Mulia Tengku Datuk Sri Azmil Zahruddin as Chair and John Ahmad Refhaq as Deputy Chair. Other non-independent, non-executive directors are Vivek Sud, Rita Skarbik, Ni Rizal Kamil, and Irfan Ul Wahab Khan. Independent non-executive directors are Vimala VR Menon, Datuk Lai John Low, and Khatijah Begum Shah Muhammad. Next, we will continue with the next slide.
Next, I will explain about the ratio comparison analysis, starting with the liquidity ratio. The current ratio remains below 1.0 throughout the 5 years. It indicates that Celcomdigi may not have enough current asset to fully cover its current liability. Similarly, the quick ratio, which excludes the inventory, shows a comparable trend starting in 2020 and lower 2023 before improving slightly to 2034. As for the cash ratio, the most conservative liquidity measure, it has declined over time from 2020 to 2024, indicating a tightening cash reserve relative to short-term obligation. Now let's move on to the asset turnover ratio. The inventory turnover ratio has been constantly high with a high spike in 2031 at 15.04, reflecting a strong inventory efficiency that year. However, the receivable turnover ratio dropped in 2022 down to 2.79, which indicates the slower collection during the merger period before bouncing back to 4.66 in 2024. Both the fixed asset turnover and the total asset turnover show relatively low and stable performance. Fixed asset turnover peaked slightly at 1.11 in 2020 and settled at 1.01 in 2034. Lastly, the total asset turnover remained below 1. It indicates that the company not be fully utilizing its total asset base to generate revenue. Let's start with the leverage ratio. The debt to equity ratio remained very high in 2022 and 2023, indicating that the Celcomdigi was heavily financed by debt during the merger period. However, we see a significant improvement in 2024, suggesting a stronger equity support and reduced reliance on debt. Next, the total debt ratio also fell from 2031 to 2034. Similarly, the long-term debt ratio also declined consistently from 2031 to 2034, showing a Celcomdigi effort to reduce long-term financial obligation. Meanwhile, the equity ratio increased to 0.45 in both 2023 and 2034, indicating that there is a stronger capital structure and healthier balance sheet strength. Moving on to the profitability ratio, the net profit margin reduced from 2020 to 2034, reflecting a pressure on bottom line profitability. However, the gross profit margin stayed relatively strong, averaging around 75% with a 76.8% in 2034, indicating a solid control over production and operating costs. The biggest shift is seen is return on equity. It peaked dramatically in 2020 at 201.53%, which was due to unusually low equity post-merger. It then normalized to 8.59% in 2034, suggesting more sustainability earning relative to shareholder equity. Lastly, the return on asset followed a similar way, falling from 2020 to 2034, showing a drop in asset efficiency.
Forecast income statement, the company projected gross profit trajectory from 2025 to 2029 actually generated using the Excel forecast linear function, a tool that applies linear regression model to historical data to predict the future outcome. This function actually estimates future values by identifying a consistent trend from existing data, assuming that change over time flow in linear patterns. Let's move on to the first chart, which is a gross profit margin, which is a gross profit margin 17.8% increase in 2025 and 19.4% jump in 2026 and 14.1% rise in 2027 and 6.8% growth in 2028 and lastly 13% recovery for 2029. For the next chart, which is a profit before tax, which is 10.8% growth in 2025, 10% in 2026, 8.5% in 2027, and the contraction about negative 2.7% and 10.6% rebound in 2029. This all based on the numbers. And then last but not least, which is a net income, which is 3.9% growth in 2025, which is 1.44 million, and 12% in 2026, which is 1.62 million, and 13.1% in 2027, which is 1.8 million. And slightly decline for negative 1.8% in 2028 and start to recover in 2029 about 10.1%. For the current and non-current asset, total assets are projected to grow from 50 million in 2025 to 78 million in 2029, representing about 55.9% cumulative increase. 2025 shows a particularly strong growth at 40% as the company resumes to expansion trajectory growth. Growth moderate in subsequent years from 2026 onward. For current and non-current liabilities, total liabilities grows from 26 million to 38 million, maintaining their 65% share, increasing from 16 million to 25 million. So the 2025 spikes mirrors the assets expansion, suggesting debt finance growth. For the equity and liabilities, it projected to near double from 24 million to 40 million, which is 36.1% increase. So the equity to asset ratio improved from 40.47% to 51%, indicating strengthening financial position. Last but not least, let's move on to the forecast for cash flow. So the first one, which is the beginning balance, about the start for the forecast here, which is 2025, which is an increase about 241.9%. From 2024 and then to 2026 about 19.8% growth and then 7.9% growth for 2027 and slightly decline for 12.4% for 2028 and a growth for 30% growth for 2029. And let's move on to the ending balance, which is the increase at 2025 116%, which is increased from 2024 and 2026 about decline 23%, and then 87% decline for 2027 and 192 increase for 2028 and 2029, decline about 49.2% decline. So the business face a major financial concern, especially due to cash flow volatility, while beginning balance are most likely stable, and ending balance fluctuate widely from 192% to negative 87%, showing the unpredictable financial patterns. A key warning sign here, the low projected cash balance, which is 46,000 in 2027, suggesting a potential liquidity crisis.
In summary, Celcomdigi faced significant financial pressure during its merger year, but show recovery in 2024, especially in reducing debt, improving equity strength. However, its liquidity and profitability remain weaker compared to Maxis. On the other hand, Maxis maintained more stable financial performance throughout the period. While struggle with declining liquidity, profitability midway, it showed clearly sign of recovery by 2024, especially on return on equity, net margin, asset efficiency. Overall, Maxis ended the period with stronger profitability, better short-term financial health, while Celcomdigi stand out for its post-merger improvement in capital structure and cost efficiency.